This is from Anton. You often mention how investing has largely been solved, but what are the aspects of investing that haven't been answered yet? So
Yeah.
my perspective on this is that they've been largely solved enough for the vast majority of people. Vast majority of people, if they just change their behavior, they can add way more benefit to their balance sheet than in trying to seek out extra handful of basis points, because some new academic research shows that you can increase your expected return. We have this unbelievable era of access to broad-based returns of capitalism for basically near free. I mean, it's so, and if I compare back to when I started, the total MERs and portfolios now are a fraction of what the marketing expense in mutual funds would have been back in the early 90s. It's just an unbelievable evolution. But what's not been solved is human behavior. People are messy, markets are noisy. And as I said to Michael Kitces on the podcast, we can look at a spreadsheet and see, or go through a risk profile questionnaire, and everyone knows that markets are volatile and how would you behave if the markets fell a certain percentage. And that's all fine, but it's the story that goes along with it. So even though the variability may not change, the story always changes, and the stories always seem to be scarier, right? And it's always, this time can be different. And then you look at Buffett, right, who's one of his greatest accomplishments, and I think Andrew Sorkin mentioned this morning that Buffett's talked about making like a dozen great decisions in his 60 years of leading Berkshire Hathaway, right? And that's that behavior that has such a huge impact. So that's my take on that.
Yeah. And we do say investing has been solved, but we say it kind of tongue in cheek. Like you said, Cameron, index funds are a pretty good approximate solution to investing for most people, but investing isn't literally solved. It functionally is, maybe, but like the recent episode with Marco Salmon was a good illustration of, yeah, index funds are great, but there are mechanical ways that they're suboptimal. So is investing really solved, or there's always something that you could do a little bit better?
Well, there's always lots to learn for sure. And there's a perfect example where he talked about, going back to the Bill Sharp paper from 91, I believe, early 90s.
Yeah.
It was amazing insights.
Yeah. Yeah, not literally solved, but the aspects that have not been answered yet. I mean, there's so much that has not been answered. What actually drives asset prices? Like we don't really even know that, and we can't, because financial economics is really still just a social science. So we can have a pretty good idea, but there are still competing theories. What's the saying? For every PhD, there's an equal and opposite PhD. For everyone that tells you factor investing makes sense, you've got an Andrew Chen who tells you that there are no more premiums after costs. And whoever tells you that premiums are risk-based, there's someone that tell you that they're actually behavioral market inefficiencies. So yeah, I mean, it's not actually solved. But the biggest thing, like from a practical perspective, the biggest thing that has not been solved, if we let's just say functionally investing has been solved because index funds are a pretty good approximate solution to the optimal portfolio for most people. Even if that is true, and you mentioned this too, Cameron, the human behavior element, it has not been solved. And I don't think it will be solved. People are just not wired for investing. People think short-term investing is a long-term activity. People are affected deeply by narratives and stories. Financial markets are an information processing machine. Like, they're just incompatible by their nature, humans and long-term investing. And I don't know if there's a way to solve that other than not giving people access to their money, but you can't do that either.
And the industry capitalizes on humans' desire to do something to avoid danger, right? Like, as I find interesting, right, going back to Buffett, so many people travel around the world to listen to him, one of the most patient investors of all time. Yet this industry puts out all kinds of articles and advice. The market's crashing, you got to do this, you got to do that, 60-40 is dead. All these things are all swirling around. So what else do you expect people to do if they're low information investors, but to react to this kind of stuff?
Totally. Yeah. And it's, I mentioned earlier that we've had our advisors let me know this morning that we've gotten a lot of questions from clients about reducing their U.S. equity exposure now that, things have changed a little bit. But the funny thing is that 6 months ago, it was the opposite conversation where people were asking, why are we still investing in EFI? Why are we still investing in Canada? Let's just go all in on the US. But it flips. The US is barely even in negative year-to-date territory, or it's not crazy negative, and it's behavior changes so quickly.
That's my point. If you just look at absolute numbers, it's nothing that scary compared to what you may have seen in a risk questionnaire.
Yeah.
You attach the story, though. The story's different. Markets keep on working.
Yeah. Yeah, it's funny. Is it what I say? Yeah. Just looking at the Apple app, I don't know. It's not the best way to look because I don't think it shows total returns, but S&P 500 year to date is down 3.77%.
That's US.
In US dollars. Yeah.
Have a look at portfolio returns here if I can get it quickly.
We're in no rush. We can maybe I'll pull up a better data source even for US return.
But year to date, most of the global portfolios on a year to date basis to May 6th are down, like a 50-50 portfolio is down like 0.37%. US core equity down 5.33%. Like that's barely headline. That's not even headline type numbers. That's year to date.
That was US core, so that's US equities.
That's Canadian listed. Sorry, that's hedged as well.
Oh, that's hedged. Okay.
So it'll be close to the US and US dollars.
Yeah.
But you take like a 70-30 portfolio, or my 60-40 I mentioned, down 62 basis points year to date.
Okay, here we go. So in Y charts, year to date SPY returns. So it's a live fund. Total return down 4.37%. And that's enough for people to want to reduce their. Well, I've got a video on this that I haven't published yet, and I want to rework it. And I actually posted it in the Rational Miner community and got a bunch of good feedback. The script. I still need to spend some time on it. But one of the things I talked about is that the market has already reduced your U.S. equity allocation for you.
Yes.
You just like how much should you reduce your U.S. equity allocation by? Well, if you just take cap weights, you've already reduced it. So anyway, next question.
What would a rational investor do with the equity and crypto market at an all-time high? I acknowledge that timing the market is generally not a good approach, but is the expected return still attractive to start investing in equity right now? Could investing in T-bonds and waiting for a market correction be a good decision, considering the current environment? From Andrea B. What say you, Benjamin?
Well, so it depends how you define rational. Like, it's easy to say, well, market timing doesn't make sense, which I think is probably true. However, we had Victor Hagani and James White on in episode 270, and they talked to us about the Merton share and dynamic asset allocation. Victor explained that the Merton share suggests that when expected returns are higher, we should, so this makes sense when you say it, we should allocate more to the risky asset. When risk is higher, all else equal, we should allocate less to the risky asset. So if we can estimate the expected return on risk of stocks, and if those risk and return numbers are changing over time, there is an argument for dynamic asset allocation. Having more in equities when risk and return is more favorable, when the trade-off is more favorable. In their model, the way they talk about it, you'd be moving out of equities into tips because you need to be. It has to be a risk-free asset that you're moving into, and tips are kind of the closest thing we can get to that. Merton share is the idea from a 1969 Merton paper that you want to size your positions in risky assets in proportion to the expected returns and inversely to variance. So for any risky bet, if the expected return doubles, you want to double your bet size. But if the volatility doubles, you want to cut your bet size in 4. And I'm just pulling this from the episode that we had with Victor and James. Now, there are a lot of assumptions in there, including normally distributed returns, which we know returns are not normally distributed, sufficient predictive power of the cyclically adjusted price earnings ratio, which is what they use to measure expected returns for stocks. And I would say that is contentious. And then the other one is that risk is not moving around in a way that offsets changes in expected returns, which it it could be. So, like, is there a case to be made that a rational investor would change their asset allocation when valuations are high? Sure. Sure, there is, I guess. I don't think I would do it, though.
That's kind of the Cliff Aston sin a little.
Well, yeah, I think Victor's sinning more than
Yeah.
a little bit different, but yeah, same kind of idea. And it makes sense logically, and then they have tested it in historical data, and it looks actually pretty good. But I mean, I don't. We're not going to start doing that. But the other thing here is that the question was asking, Andrea was asking about all-time highs, not about valuations or expected returns. Victor and James would say when expected returns are low, you should reduce your allocation to stocks. Okay, that's fine. But the question is asking at all-time highs, which is a different question. All-time highs are relatively common. Like if you go and look in the data, if you just look at stock indexes historically, roughly on a monthly basis, 20 to 30% of months, you're at an all-time high, depending on which index you're talking about.
I think we had 40. I think I heard there was 42 all-time highs last year.
I believe it. I mean, but the market goes up, right? Like you're going to have all-time highs. That's just how something works when it goes up. But the interesting thing is investing at all-time highs has historically not led to worse returns than investing at all other times. I've seen some research even suggesting that investing at all-time highs gives you better returns. I don't know what horizon that's over. I modeled this out at a 3-year horizon, and there was nothing interesting there, so I just kind of scrapped the model. I found that if you invested rolling 3-year periods going back to 1926 in the U.S. equity market, and this is just from my head because I deleted the spreadsheet because it was not interesting. Rolling 3-year returns, if you invested only at all-time highs, your return was nearly identical to investing in any month. So that's all I got. Investing at all-time highs doesn't matter.
The thing I would caution is if you do it to make it very rules-based, if you can, because you have the risk of becoming overconfident, especially if you get the first one right. Mm-hmm. You might increase the size of your bets going forward. So I would encourage people to make it very rules-based to avoid that.
So use the Merton share. If you must, do what Victor and James talked about in their episode 270. That's it?
That's it.
Okay, next one. Most of my investments are in my... Oh, this is a fun one. Short but fun.
For you.
Most of my investments are in my holding company. Most of it is stock. Now the capital gains will be taxed on a bigger portion, 67%. That's the inclusion rate going up. Is it a good idea to take some money out as dividends and invest personally in the stock market to be taxed on a lower portion, 50%? 50% inclusion rate personally up to a certain limit is what the rules were at the time. They also receive a salary from another operating company, and they've got a maxed out RSP and TFSA, and they tell us the marginal tax rate. That's from Sylvain, a small business owner in Montreal. Now, the reason this one's fun and the reason that it's interesting is that it's kind of this time capsule of a time before when the capital gains inclusion rate was going to increase and when there was a difference between how corporations were going to be affected and how individuals were going to be affected. And there was some really potentially interesting planning around that. We did a Money Scope episode on this specific thing. We even walked through an example like this where we showed that in some cases, maybe it could make sense to do what Sylvain's asking. But those changes didn't end up happening, and they're not going to. At least it seems extremely unlikely that they will. So I think the real lesson here is that tax uncertainty can be as difficult to navigate as market uncertainty. Maybe it doesn't happen as frequently, and maybe we have a little more control over how it affects us, although that's not always true. But I mean, people that made really aggressive changes or prepaid capital gains by realizing gains leading up to those changes, I mean, they ended up getting burned. So it's just a really interesting example of this was a really interesting question when it was asked, and there was some interesting planning that could have been done around it. If you had done that planning, it would have ended up being not so great in the end.
Okay, I'll read the next one and I'll let you answer it because I think the next one's your happy place also. If private banks can easily create money through lending and their primary disincentive to issuing bad debt is the need to maintain profitability, what mechanisms or constraints prevent them from excessively creating bad debt, given that there appears to be little direct cost of doing so? There is no financial consequences as this is opportunity cost rather than a monetary loss. Thanks for your time, Shmuel.
So I'm not like an expert on banking. I spent a lot of time reading about it to make that video, and I spent a lot of time talking to people who do have expertise in banking before making that video. So I'm going to talk about what I know, but to be clear, I'm not an expert in this. So when a bank makes a loan, it creates a deposit, which is a liability to the bank, and it creates an asset, which is the loan. Loans are assets to a bank. If the loan becomes worthless, the bank is left with no asset and a liability, and that affects the bank's equity, and it can also affect the bank's profits because they're not going to get income on that loan anymore, on the asset anymore. Like in an ideal case, the bank makes the loan, earns the interest on the asset over the life of the loan, and if the loan defaults, the bank loses that income and also loses the asset. So that banks don't want that to happen. It's not good for them. They also have regulatory constraints. They're required to maintain certain capital ratios relative to their risk-weighted assets, and bad loans are going to eat into those ratios. In addition to regulations, they have to remain profitable. If they're making wild loans that can't be repaid, they risk insolvency. And the bank's credit rating and reputation also matters. If it wants to raise capital, external capital, if it's known as the bank making a lot of bad loans, like no one's going to invest in it. So I think there are lots of different, both economic and regulatory constraints that stop banks from going crazy. It has happened. Like it happened in the US. There were a lot of wild lending that happened leading up to financial crisis. It happened in Iceland and they had a big financial crisis. So it's not that they can't happen, but there are constraints, and eventually those constraints do become real.
Exactly. Okay, you take number 8.
What do you believe is the most costly mistake that people can make in their personal finances? Nolan from Calgary. Okay, I'll go first. Not investing is a big one. And there's lots of interesting academic research on this that a lot of people don't invest or they underinvest. And then along a similar line of thinking and a similar line of research, a lot of people don't take enough risk. So they do save, but they don't take enough risk with their savings. I think those are huge. Taking the wrong kinds of risks is also big. So, investing in only penny stocks or only crypto or only options or whatever. Those are probably also big mistakes. And then another big one is getting divorced. Like that's up there with, you can't really call it a mistake. But it's one of the costliest personal finance outcomes that can happen to people.
Well, I won't dispute you on that. Divorce can be quite a financial hurdle for anyone that's gone through that. But stepping back, big picture, we see so many people obsessing over squeezing a bit more return, and they don't have a plan in place. And better behavior, especially when you're starting out, will have a much greater impact on your balance sheet than squeezing out some speculative bet you're trying to make. And I see a lot of that, especially with like young people just starting out. A lot of people just don't have a plan in place. They don't know what kind of return they need. And that helps inform you on your ability, willingness, and need to take on risk, the need part, to help you decide what's a sensible portfolio, which leads back to your comment about knowing and being able to take on the risk that can lead to a better outcome down the road. And that's the big ones for me. Define your why. What are you saving for? What's the plan? That's also interesting too. Like I think back to that great work you did on goal identification, right? Ask you once, ask you twice, and keep digging again. It's such a fascinating exercise because often, someone might think of their goals and it's like, okay, get a house or educate my kids or retire at a certain age, but there's so much more to it than that, than just the easy, quick answers. And we're all so busy, right? We often don't take the time to think about these things, but that's so vital. So few people I think, have a financial plan. So few people have a will.
Yep. Yep. It's true. Takes time and effort to do that stuff. It's not a, yeah. It's easy to forego, easy to defer.